Welcome to class number 17. During our last two classes, we learned about equity securities like stocks and debt securities such as bonds. At the end of our last class, I mentioned that investing in individual stocks and bonds can be very risky. As such, diversification is a very critical concept to learn for almost all retail investors. We're going to discuss diversification a lot more in future lessons. But for this class, I want to lead off with a story. How many of you have heard of Enron? Well, for those of you who don't know, Enron was a very large U.S. corporation in the energy industry. In fact, by the year 2000, Enron reported revenue of over $40 billion and employed about 29,000 people. The company placed 18th on the Fortune 500 list, which ranks U.S. publicly traded corporations by revenue. At the end of 1997, Enron stock was trading at about $20 per share. By mid-2000, the price jumped to over $90 per share. Let me say that another way. In 2.5 short years, the stock price more than quadrupled. Investors went crazy for Enron shares, thinking that the company couldn't lose. In fact, many Enron employees were so enthused with the stock that they put their entire life savings in Enron, including their retirement. If I had a time machine, which I promise you I don't, you could witness this mania firsthand. How could anyone lose? Who would want to miss out on such a great opportunity? Would it have been smart to invest a significant percentage of your money in Enron? Well, unfortunately, the Enron story doesn't end very well at all. Towards the end of the year 2001, a massive accounting fraud at the company was revealed to the public. One reason why Enron seemed so profitable was that it was hiding a significant amount of debt and losses off of its financial statements. Once concerns were raised and an investigation took place, authorities found that Enron's external auditors made crucial mistakes which failed to uncover the fraud. The CEO and CFO of Enron were both convicted of criminal charges and sentenced to long federal prison terms. The accounting firm that audited Enron, Arthur Andersen, collapsed amid multiple scandals. By the end of 2001, Enron's stock was effectively worthless as the company filed for bankruptcy. In a few short months, the value of its shares, which reached tens of billions of dollars, was wiped out, and so were many investors. Imagine working your whole life, getting to almost retirement age, and your entire life savings is wiped out in a matter of months. That extraordinarily painful event happened to many people. Now, many of you will say, what are the chances that a company I invest in will be the next Enron? Not very likely. However, the lesson here is that if an investor diversifies properly, that risk is taken off the table completely. We'll learn later that investors who diversify have less risks than those who don't diversify as much. And those investors receive better returns in the long run than almost all investors who are not well diversified. Beginning with this class, we're going to talk about tools investors might use to diversify their investments. If you were to go out and try to buy a wide range of stocks and bonds to diversify your portfolio, it would be very expensive, time-consuming, and difficult. Think about it. Imagine trying to buy a share of each of the 500 largest corporations in the US. If only there was a way to buy a diversified set of stocks or bonds. We are able to buy a wide range of investments all at once using an investment instrument called a fund or an investment fund. An investment fund is an investment vehicle that allows investors to hold a small piece of multiple stocks, bonds, and or other investments all at once. An investment fund is run by an investment firm that manages the selection of investments in the fund to match the investment strategy that the fund is pursuing. For this service, the fund will normally charge investors a fee. In return, investors will receive the weighted average return of all investments held in the fund over the time that the investor holds the fund investment. Let's go through some more of the basics. Investment funds can be traded on an exchange or, in some cases, over the counter using a network of brokers and dealers. Generally speaking, investors either buy shares in a fund or, for some funds, partnership interests. That is, an investor is effectively a limited partner of the investment partnership or the fund. Investors can receive dividends or interest from the underlying investments in the fund, the same as if they held the individual investments directly. In addition, investors can have gains from the appreciation in value of the underlying investments and losses from the depreciation of value of the underlying investments. In summary, returns from funds consist of dividends, interest, and capital gains. But always remember, these returns will be netted against any fees that the funds charge investors for the service of running the fund. Some funds have very low fees, while others have very high fees. We'll talk more about how to evaluate these fees in future classes. But for now, just know that it's important to be aware that a fund manager charges fees to those invested in the fund. Beginning in this class and continuing in next class, I'm going to introduce you to various types of investment funds that you might encounter on your investing journey. The first type of investment fund that we'll cover is called a mutual fund. A mutual fund is a type of fund that is typically offered to investors through retirement investment accounts such as 401k plans, but also could be bought through a brokerage account. Mutual funds are highly regulated and are managed by mutual fund companies, which are a type of investment firm. A mutual fund is typically divided into shares. These funds typically have a 5-character ticker symbol, with the last character being an X to distinguish itself from other types of investments like stocks. Mutual funds can hold a mix of stocks, bonds, cash equivalents, and or other investments, depending on the strategy pursued by the fund as set by the fund manager. These strategies may also be called themes. There are all types and combinations of strategies that investment funds, like mutual funds, may pursue, and it's important to have a basic understanding of the strategy of the fund if you're considering investing. For example, a fund may have a high yield or growth strategy. This generally means that the fund will be buying higher risk investments like lower grade bonds and or stocks in emerging companies with a high potential of growth, but that also have more risk than established companies. Conversely, a fund may have an income or value strategy. This generally means that the fund will be buying lower risk investments like high-grade bonds and or stocks in established companies with a lower, more stable growth potential, but that can return a more steady income stream to investors than high-risk companies can. Funds can also have a domestic or U.S. focus, an international focus, or a mix of the two. Funds can focus their investment on smaller corporations, also called small caps or small capitalization, medium-sized corporations, also called mid caps, and or large corporations, also called large caps. Funds can focus on investments based in developed countries, which generally means in well-established economies such as the US, the UK, and Japan. Or they can focus on investments based in emerging markets countries, which generally means less established economies such as India, Brazil, and China. A fund can even focus on alternative asset classes such as real estate, hard assets like gold and silver, and many others. Don't worry, you won't have to memorize or study all of the different themes that fund managers might use, but it is important to understand the general strategy of any fund you are considering investing in, so you understand the risks and whether that fund is right for your investing goals. On the highest level, the management of a fund will fall into one of two approaches: an actively managed approach or a passively managed approach. I promise these are not as complicated as they sound. Let's stop here and we'll explain these two approaches in our next class. We'll also introduce you to index funds, which are passively managed funds that are very popular with investors due to their diversification benefits. We'll also discuss various other types of investment funds and some key things to look out for when you're choosing to invest in an investment fund. That's a whole lot of information, and there's much more to come on this. Don't miss it. If you have any questions at all, I encourage you to contact me at opusmonetayquestions@gmail.com or comment below, and I will try my best to get back to you as soon as I can. Thanks for watching. If you found this content to be helpful, I'd like to invite you to hit the subscribe button and give us a like. You can find additional resources, insights, and motivation by following us on Instagram and TikTok. Also, we greatly appreciate your recommendations. If you think this content may help your friends and family, share the wealth and let them know about us. See you all in class number 18. Peace!